Welcome to the Deep Dive, your shortcut to being well-informed on the major moves shaping the tech industry.
Today we are tearing apart the Q3 fiscal year 2026 earnings for Marvell Technology, ticker MRVL.
And this was less of an earnings call and more of a total strategic overhaul.
Exactly. This was a statement of intent. The intense after-hours reaction wasn't just about a comfortable earnings beat.
Right.
It was the market validating a profound narrative shift. Marvell is strategically shedding assets and really doubling down on becoming a pure-play, high-end AI infrastructure provider.
Our mission today is to distill exactly what management said, why they were so aggressive in their guidance, and what this radical restructuring means for their growth over the next, 3 years?
At least. This is not a short-term story. It's a multi-year pivot.
Let's jump in.
Okay, so we have to start with the immediate snapshot from the call. This was December 2nd, 2025.
On the surface, it looked like just a solid, clean quarter.
It was. They reported record revenue of $2.075 billion, which beat the street consensus slightly. Strong 37% year-over-year growth.
And the core profitability was there. Non-GAAP EPS, that came in at $0.0276.
Comfortably clearing consensus, which was around 74 cents. And they kept that non-GAAP gross margin strong, too, at 59.7%.
Okay, but we need to address the GAAP number really quickly.
We go.
Because people will see a GAAP EPS of $2.20 and think something incredible happened.
Right, but that staggering number was almost entirely due to a massive $1.8 billion pre-tax gain.
And that gain came from the sale of the Automotive Ethernet business?
Exactly, a one-time event. So the core story isn't that headline number, it's the underlying performance.
So what drove that organic strength then?
It was the data center segment. I mean, it's now the undisputed engine of growth for them. That segment alone brought in $1.52 billion in revenue, up 38% year over year.
And that momentum is really the foundation for everything else they announced, isn't it?
It is. It's what gave them the confidence to do everything else.
Okay, so let's unpack that strategic pivot. The portfolio changes. First, the divestiture, and then the headline-grabbing acquisition.
Management described this whole move as playing offense. The $2.5 billion sale of the Auto Ethernet business to Infineon that, simplified their operations.
And freed up a ton of cash.
And removed a big capital expenditure requirement. It was all to set up the next move.
And they executed that next move immediately. They announced the acquisition of Celestial AI for $3.25 billion.
Which is a mix of cash and about 27.2 million Marvell shares. This is a massive directional signal.
It is. So for listeners who aren't deep in chip architecture, what is Celestial AI and why is this photonic fabric worth over $3 billion?
What's fascinating here is that Celestial AI solves an existential problem for the AI industry right now.
Okay.
As these AI clusters get bigger and bigger, spanning racks and racks of servers, the standard copper wiring that carries data between the chips, it's hitting a physical limit.
Like a crowded highway.
A very crowded highway. Copper just consumes too much power, it generates way too much heat, and the signal degrades really fast over any kind of distance.
So if copper is the congested highway, the photonic fabric is like a high-speed hyperloop.
Precisely. Celestial AI brings technology that uses light photons to transmit data instead of electricity. And this optical solution, it gives you more than 2 times the power efficiency of copper.
Which is huge.
It's huge, and it dramatically lowers latency, and critically, it maintains thermal stability.
That thermal stability sounds like a technical detail, but it's actually the key to their whole packaging strategy, isn't it?
It is absolutely critical. Because the photonic components are stable, Marvell can co-package them directly, vertically, with high-power XPUs and switches. It's called 3D packaging.
So they're building up instead of out.
Exactly. Think about the edge of a chip as valuable real estate. The industry calls it beachfront. Standard solutions eat up all that beachfront. By co-packaging the photonics inside, they free it all up.
Which means?
It means that valuable die edge, that beachfront, can now be repurposed for more HBM memory, the super fast memory that these chips are starved for.
So they're solving the data movement problem and the memory bandwidth problem at the same time.
Simultaneously. This is a transformational move that directly challenges competitors who might need external, less integrated photonics.
And management sees this opening up a whole new market, a $10 billion TAM?
Yeah, a new $10 billion total addressable market just in high-speed interconnects. It's massive. But they were also careful to set expectations on the timing.
Right. This isn't an overnight success story.
No, not at all. They were very transparent. They expect meaningful revenue from Celestial to start kicking in during the second half of fiscal year 2028.
But the targets are aggressive once it starts.
Very aggressive.
Okay.
A $500 million annualized run rate by the end of fiscal 28, doubling to a full $1 billion run rate by the end of fiscal 29. That's why this is a structural, multi-year play.
And to sort of validate all this, the deal came with a massive vote of confidence from a Tier 1 hyperscalers, Amazon.
All right. Amazon gets a warrant to buy Marvell shares, and it's tied directly to how much of this photonic fabric they buy through 2030.
So it's a huge incentive for them to adopt it quickly and align strategically.
It means the tech isn't theoretical. It's already aligned with one of the biggest customers on the planet. It's a very tangible sign of future revenue.
Okay, so this is where we transition from the huge acquisition story to the core organic growth that's underpinning all this confidence. Management didn't just guide for Q4. They laid out a framework for the next 2 fiscal years, which is visibility we almost never get.
Right. First, Q4 fiscal 26 guidance is solid. Revenue forecast at $2.2, so we're $1 billion at the midpoint. Non-GAAP EPS around 79 cents, but nobody was focused on that.
Everyone was looking ahead. For next fiscal year, FY2027, the total organic revenue outlook is implied to be right around the $10 billion ballpark.
Which is a huge statement, especially after a year with so much change. And they're raising expectations for their growth engine.
The data center.
The data center. They raised that revenue growth outlook to more than 25% year over year. And they specifically pointed to cloud CapEx, which they now see growing above 30%, and said Marvell is outgrowing even that.
Let's break down those growth segments because this is where the jargon starts to fly. Let's start with the custom business.
A key driver. They expect that to grow at least 20% next year. But here's the confidence nugget.
The purchase orders.
They already have purchase orders secured for the entirety of their lead customer's next-gen XPU program forecast for the year. That gives them extremely high visibility.
Okay, so that's custom. What about the networking side, interconnect?
Interconnect demand is accelerating. It's not just their leading PAM DSP products for, 800 gig and 1.6 terabit speeds. It's also from their newer components.
Which brings us to the alphabet soup, AECs and retimers. For listeners, what are these and why are they suddenly such big growth drivers?
Okay, so think of AEC's active electrical cables and retimers as the essential cleanup crew for data signals. As data travels farther inside a rack, the signal degrades. Retimers regenerate that signal, they clean up the noise, which lets it go farther. And AECs basically package that solution right into the cable itself.
And you need these for high-performance AI.
They are absolutely mandatory in these AI clusters. Management expects those two products to more than double in revenue next year, combined. They are the plumbing of the AI factory.
And finally, switching. Revenue there is forecast to pass $500 million next year, accelerating because of the ramp of 51.2T products.
When we talk about 51.2T switches, we are talking about the highest end of the market. The T is for terabits. This is the state-of-the-art for major hyperscalers.
So the fact that it's accelerating means they're gaining share where it really matters.
Exactly. But this confidence, it doesn't even stop in fiscal 27. Management believes growth actually accelerates even more in fiscal year 2028.
This is the big one. They're projecting a massive data center revenue growth of 40% in FY28.
That 40% projection is audacious. It's predicated on the custom business doubling off an already higher base.
And this is where that XPU attached market comes in. Another bit of jargon we need to define. We're talking about CXL and smart NICs here.
Yes, and these are solutions to the fundamental bottlenecks of AI. Take CXL Compute Express Link. It's an interface that lets the GPU or XPU dynamically pool and access huge amounts of memory across different components.
So it turns a memory silo into a memory lake?
That's a great way to put it. And smart NICs, they are network cards that are, well, smart. They take on heavy data processing tasks like security or virtualization, and they offload them from the main, very expensive XPU.
So they manage the data traffic without bogging down the main processor.
Exactly. And Marvell sees a line of sight to over $2 billion in revenue from just these two attached use cases by fiscal 29.
Let me just push back on that a little. A 40% growth rate in FY28, requiring the custom business to double, that's based on design wins secured years ago. Aren't they taking a huge execution risk by being so public with these targets?
It is a huge risk. But their confidence comes from having those purchase orders locked in for the next-gen XPU program. The risk isn't so much securing the business anymore.
It's the execution.
It's the flawless execution and manufacturing ramp required to meet that demand. But that level of visibility is exactly why the market reacted so strongly.
And it did. The stock jumped, high single to low teens % in after-hours trading, a massive repricing of the whole business model.
The rally was driven by that perfect storm. Beat the quarter, raise the near-term guidance, and then provide this believable blueprint for $10 billion and accelerating growth.
And the Celestial acquisition just cemented the idea that Marvell is transforming into a silicon photonics powerhouse.
And it's important to remember, Marvell had actually been lagging the broader semiconductor index, the SOXX, over the past year.
Right.
This report signals that investors are finally pricing in that long-term narrative. They're seeing them not just as a diversified company, but as a focused AI infrastructure platform. Goldman Sachs even raised their price target from $80 to $90 because of this.
The message is clear. Management is confident. The market is following. But the test, as you said, is execution.
It's all about execution, integrating Celestial and delivering on that incredibly long revenue ramp.
All right, now for experienced investors listening, let's leverage this multi-year visibility for our This Is Not Financial Advice segment.
So I want to connect the dots here. The market is celebrating the FY27 visibility right now, that $10 billion revenue target.
But the true exponential payoff, the part that really transforms the company's valuation, is tied to fiscal 28 and 29.
The doubling of the custom business and hitting that $1 billion Celestial run rate, that's the real prize.
So what's the outrageous but plausible trade?
Given the guidance suggests their data center segment could sustain a 50% compounded growth rate through fiscal 28, we'd pitch an aggressively long-dated out-of-the-money call spread expiring in January 2028.
So it's a conviction play. You're bypassing all the short-term volatility and betting specifically that management hits those huge targets 2 years out.
It's a high-conviction bet on long-term execution and their domination of the AI rack.
We covered a lot of ground: a clean beat, a strategic divestiture, a transformational acquisition with Celestial AI, and an organic growth outlook targeting 40% growth in FY28.
The message Marvell sent is unmistakable. They've shed non-core assets to become a leading pure-play AI infrastructure provider. The path to becoming a $10 billion plus revenue company is now credibly outlined.
So we'll leave you with this to think about. What stands out to you about their confidence in that FY 2028 custom business doubling, especially when you consider how complex integrating that new photonic technology is going to be?
Thank you for joining us on this deep dive into Marvell's strategic pivot.
Remember, this discussion is for informational purposes only and does not constitute financial advice.